You take a look today, it's in the 17s, right? And we were just down all the way into the 14s. Why is that? Well, I think in anticipation of the Fed, certainly that's kind of building up in there. What we've seen today, and that's why we're seeing such a perk to the upside today as well. But let's not forget this. It's just 2 weeks ago, man. It was 2 weeks ago where we were sitting there at 65 in the pre-market. The fact that it pulled back as fast as it did makes a lot of sense, I think, in some ways. But in some ways, you also have to figure, well, maybe there's a little bit of something left in there. Maybe there's some movements going on. And certainly everything that's in front of us over the next, call it 24, 34 hours or so, could be fairly big catalyst and actually get us moving, I think, in one direction or the other. But I wouldn't be surprised to see the volatility index test 20 again, maybe. On the other side of that, I also wouldn't be all that surprised if things go a little bit better than that we see the volatility index maybe pop a little bit and then pull right back down towards 15, 16 again, which is exactly where we just came from when we were in that 14 to 17 sort of a roll. So I think that the range is something interesting, but something that we should keep an eye on. And now it's all up to Powell where it goes from here.
Yeah, it will be, of course, him describing, Pete, why he's only going to give us a quarter point, which is another reason the markets might be softening. Because at some point, since the predominance of CME votes with their money, not just with some sort of straw poll, indicate that it's nearly a certainty that it's going to be 25 basis points. That's priced in, Pete. Mm-hmm. So we get 25 bips. We might get a move just for a few minutes or even an hour, but I would fade that because if it's priced in, we got room to the downside because we're at all-time highs for a number of these indices.